The shorts illegally colluded with each other to stop both AMC and GameStop from squeezing yesterday. Today I want to talk about how these shorts colluded and break down their plan, but explain ultimately how this plan will fail, causing the AMC squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So there's actually a number of different parties involved in this collusion. We've got the mainstream media and the shorts, we've got S3 Partners, who is actually partially owned by Citadel, we've got the HKD stock itself, and of course we have the SEC. So Ryan starts us off by posting on LinkedIn saying, here we find an article that was timestamped 9:51 Sunday, October 30th, reporting on the GameStop stock price shooting up and halting on the Monday trading session on the 1st of November, which hadn't actually happened at the time of posting this article. He said Yahoo Finance writers must have psychic powers to know exactly what will happen in the stock market the night before it actually happens. This Yahoo article was posted Sunday, October 30th. It says GameStop shares jumped shortly after Monday's opening bell. It was earlier near $35 per share, but fell to just under $30. It's crazy how Yahoo knew the exact price that GameStop would run to the day before this trading actually happened. Peter Han posted saying this happened a few times last year with AMC price moves. How could somebody at Yahoo Finance knew what GameStop was going to do 12 hours before it happened? He said a logical conclusion is that they pre-wrote the story and that it was accidentally released early, but how would they know the exact prices? He asks, is the market makers' control over the pricing of GameStop so exact they can confidently tell someone in the media exactly what the price action will be? And as a perfect prime example, you may remember a few months ago the Inquisitor released an article on Dwayne Johnson's Black Adam failing at the box office back in September before the movie was even released in October. Again, how would the Inquisitor know how the Black Adam film was going to perform at the box office before it was even released, unless the article was pre-written regardless of the outcome to simply spread more FUD? But actually it goes even deeper than that. As Tendy Baron tweeted, he said, remember that Chinese IPO stock that we know has been used to generate collateral for these short hedge funds, HKD? He said it's the stock that ran from $12 per share to $2,555 at the end of July and the start of August. Well, that stock yesterday traded very similar to the GameStop stock and the AMC stock yesterday on Monday. We can see here both the charts for GameStop and for HKD overlaid on top of each other. It looks like HKD was pumped at the exact same time that GameStop was running to generate additional liquidity for these shorts. The HKD stock was pumped to generate this additional liquidity, so these shorts on GameStop weren't actually liquidated or margin called. Now it's important to remember, as I said yesterday, these shorts don't actually get liquidated when their position goes 1 cent past their margin call position. When they get margin called, they actually have 2 weeks to satisfy this margin call, or else they do get liquidated. Therefore, it's not a case of the GameStop stock running past $30.01 and an instantaneous liquidation. It has to hold above $30 for 2 consecutive weeks, if not longer. But obviously if these shorts are also pumping HKD at the exact same time to generate more liquidity, they avoid the margin call altogether and simply don't get margin called or liquidated. But it seems this actually may have been an elaborate illegal plan all along. These shorts knew that GameStop was running up and would likely squeeze and that many hedge funds would be margin called. So they colluded to borrow tons and tons of shares, to pump up stocks like HKD, and to promote a mainstream media FUD campaign to again push the stock back below $30 so that nobody experienced this margin call. And also guys, be sure to join the free Discord link in the description below. We've got 1348 indicators and we talk about AMC and share due diligence all day long. And obviously if you haven't yet signed up to Moomoo, you can currently get $10 absolutely free, and on top of that 15 free shares worth up to $2,000 each, a whopping total of up to $30,000. As Meathead said, let me get this straight, around 90 million shares were borrowed in one day last week on GameStop, and the stock was up around 25% today. It seems these shorts likely borrowed all 90 million of these shares last week to use in this one singular day. As I said, they knew that GameStop was running up, they knew that it could cause the squeeze, and therefore they needed desperately to push the price back down. They pumped up HKD to generate additional liquidity, and they used all 90 million shares they borrowed last week to short simultaneously. And it seems that S3 Partners may have been the catalyst for their plan, convincing retail investors to buy tons and tons of call options to increase the volatility on the GameStop stock. With this additional volatility, they could use all 90 million of their borrowed shares and all of the extra liquidity that they generated to push the price of GameStop back down, harvesting all those call option premiums. As Nate tweeted, he said, well, would you look at that? S3 Partners are owned by Citadel. So S3 Securities was a subsidiary of S3 Partners and partially owned by the Knight Capital Group. And then it seems the Knight Capital Group was bought by Citadel back in 2016, and Citadel also bought S3 Partner Data and Services back in 2013 as well. So it seems like Citadel has the majority interest or holds the majority holdings over S3 Partners. They bought S3 Partner Data and Services outright back in 2013 and bought the Knight Capital Group, which purchased S3 Securities separately. So it seems like the S3 Partners interview was simply a catalyst to trigger all of us purchasing the GameStop stock, pushing the price up, where they could use their borrowed shares to short the price back down. And as Charles Payne tweeted, he said the simple answer is the SEC has never been obsessed with protecting small investors. He said they shut down all of the small brokerage firms while allowing Enron and Madoff and others to run amok, and they're currently sitting on their hands. He said when the Fed is stroking the market, the SEC never gets in the way. So again, it seems the SEC is also complicit as they're allowing all of this corruption, all of this manipulation, and all of this illegal collusion to go on under their noses without doing anything about it. But ultimately, over the next few weeks, GameStop will slowly push above $30 per share, causing a massive headache for these hedge funds, causing a number of margin calls. And it seems like actually a number of different institutions are on board, buying up tons of the GameStop stock and buying up tons of GameStop call options. Some of these hedge funds or institutions know the shorts can't hold GameStop down forever. They know it will naturally slowly increase above $30 per share, and they know a natural parabolic move is coming. These institutions know these shorts are going to try and create catalysts to push the price up and then dump it back down, but they also know the price will naturally continue climbing, causing a massive wave of liquidations. And why these shorts are so terrified and why other institutions are taking advantage is because they know exactly what kind of situation the market is actually in. Many of these institutions know that a short squeeze will happen when these shorts lose loads of money, and something that will cause these shorts to lose loads of money is the market crash. The interview over the weekend with the founder of S3 Partners wasn't actually wrong. Yes, the shorts used that interview to their advantage, using it as a catalyst to steal option premiums from us, but the data and information contained in that interview was actually correct. As these shorts lose more money, they will end up being squeezed. Many of these major tech companies are indeed failing, causing these shorts to lose hundreds of millions, if not billions and trillions of dollars. And Credit Suisse is struggling so much that it's now giving its shareholders the choice of going along with its plan and suffering a lot, or refusing one or more parts of the plan and suffering even more. As Ryan Rigg tweeted, he said Credit Suisse's $4 billion fundraising event was always going to be painful for shareholders, but with a deep discount on the new stock, their choice is only about how much of their ownership they want to lose. Credit Suisse has promised a weak target for only a 6% return on tangible equity in 3 years' time. That's far below the 10% cost of capital assumed for big banks. It means that Credit Suisse expects to be destroying value for its shareholders when the restructuring is done. Therefore, Credit Suisse expects its shareholders to lose money and be happy about it. And the details of that share sale, which the bank released on Monday, leave investors with no real choice at all. The Saudi National Bank is putting in $1.8 for a 14.8% stake. That's to be followed by a $2.2 billion rights issue. That stock will be priced at only $2.51 per share, which is a 32% discount to the theatrical share price. And the rights issue will further dilute the claims of each share over Credit Suisse's profit or book value by 22%. So it seems that Credit Suisse is screwing over its shareholders just to generate this $4 billion of cash that it needs to stay afloat. If Credit Suisse is happy to screw over its shareholders just to survive for a few more days, I think it really shows what kind of situation the market is really in. Because as a prime example, it's not just AMC and Gamestop where these shorts have massively over-leveraged positions, it's also in smaller companies like Cineworld as well. The Cineworld stock at one point today was up over 277%. So far it's still up 167% at the time of making this video. A price gain of 277% in one single day is enough to cause a massive headache for these shorts. And obviously if we saw GameStop or AMC run 277% in a single day, it would likely trigger the squeeze. Something I also found very interesting is that while Cineworld right now is only trading for £6 per share, only a few years ago it was trading for over £300 per share. If a small UK company like Cineworld can trade over £300 per share, it's very easy to see how a major company like AMC and Gamestop could trade well over $300 per share, likely into the thousands. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.